Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick, Chief Strategist at Interactive Brokers, to discuss the pros and cons of the stellar outperformance that we've seen in the Nasdaq 100 mega caps. Steve, it's great to see you as always. Welcome back to Trade Talks. And we kind of have this truism in the market where you want to see broad strength, not so concentrated. What are your thoughts around that?
Good afternoon. Great to see you again, Jill. That's typically something we want to look for. Think of it like if you're building a tall building, would you rather have a broad base as a foundation, or would you rather have a narrow base as a foundation? Common sense would say you want the bigger, wider foundation. And I think the same applies to stocks without overstretching the analogy. What we want to see here is a market that is where there's participation at all levels, not just a race into the top most popular names. And so one of the ways we want to look at that is, it's a little tough to see on the chart, so squint if you can, but at the very right-hand side there, we have the advanced decline line for NASDAQ, and the top is the NDX, and the bottom is the advanced decline line for based on the stocks that trade on the NASDAQ exchange. And normally we would want to see the advanced decline line either confirming new highs or participating, and we're not even close. This last leg up in the market has really just been led by the big cap tech stocks and without much broad participation. And that's concerning because that adds to a certain amount of fragility. One of the things that is a difficulty with narrow leadership is if something goes wrong with one of those leaders, the index itself suffers. And I think we see that today, where Tesla is severely underperforming because market I think got overenthused about its deliveries, and that stock's down substantially, and it's, to a certain extent, it's pulling NDX along with it.
And Steve, I want to take a look at your next two charts here, because here you look at the NASDAQ 100 versus the NASDAQ Composite.
Yeah, I started to see if there was a way to quantify, the outperformance, let's say, of these tech names, what I'm going to call the mega cap tech names. And NDX, is extraordinarily highly weighted with mega cap names. Basically, Apple and Microsoft are the two top names. They're about 25% of the index, when the first 7 stocks or so are about 50% of the index. NDX has always been a bit top heavy, but I don't ever recall it being this top heavy. So I figured, let's compare it to the NASDAQ Composite, which is a very broad-based index based on the stocks that trade on the exchange. They correlate extraordinarily well. The bottom third of that graph is the correlation, and it's tough to see, but realistically, it ranges from about 97 to 99. So they correlate extraordinarily well. But the middle part, that green bump at the end there, is the part that to me is most significant. That's the spread between NDX and the comp. They've tended to trade very closely together for most of the history. And you could see that the NDX outperformance, it's a huge record. That's a 30-year chart. We've never seen anything like this. And what we're seeing in the past few months or so, it way outpaces anything we'd ever seen before. And so that, to me, is another sign that we're just not getting this broad-based participation. It's great if you're in those names, but it can be a little misleading as you look at some of the benchmark indices.
Right. Well, I also think an important distinction to make is that we don't have financial companies in the NASDAQ 100, whereas the comp does. And of course, we saw what happened in March with the financials. So that is part of it as well. But Steve, I want to talk about another anomaly, if you will. On Friday, the all-important jobs data comes out, the non-farm payrolls report. The government is open, but the market's closed. So we won't be trading the data that day, but they're still going to put it out there.
Yep. If people say that the government is inefficient, maybe this is one of the things you can use against that, to counter that argument. We have had this situation before. Just 2 years ago, it happened in 2021. It does. If it happens in April, because Good Friday is a holiday for the markets and not for the federal government. For those of us who are in the markets, I hope I'm not speaking for you, Jill. It's nice to have the day off while everybody else has to work.
Oh yeah,
it's the only time it happens. But notwithstanding, so we do have that interesting anomaly of getting probably the most crucial piece of economic data on a day where stocks are closed. Bonds will be open. The banks, for the most part, are open. So currencies will be open, but we're going to have a delayed reaction. When it happened in 2021, remember, we were in the cusp of a raging bull market, and we were up about 1.5% the Thursday before Good Friday, and then up another percent and change on the Monday, because the payrolls numbers that day were super strong. That obviously that was in a very different context. We were coming out of the COVID recession, and we wanted super strong payrolls numbers. Now I'm not so sure that a beat of that nature would be greeted nearly as well. We're looking for about 220,000 on the consensus, the unemployment rate at about 3.6%, and the very important monthly wage increase, hourly wage increase of about 0.3. So, the question becomes, remember, the Fed mandate is stable prices and full employment. We get a look sort of at both of them, because we get certainly we get an employment look, but also with the wage numbers, we get a look at whether wage inflation is problematic as well. So stay tuned, and this time Monday could be an interesting time to fasten your seatbelts.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.